And I would urge you guys that in as much as you want your money to work for you, it's very important that you check the SEC website to see whoever you're giving your money to, whether the fund management company is actually licensed or that product is actually licensed, so you don't fall into scams like what we've seen in the likes of Men's Gold and others, right? So always it's very important that you check that the mutual fund or the unit trust is actually licensed, and also the fund manager is in good standing with the regulator. All this can be found on the website of the SEC Ghana, right? If you look at a little bit about myself and how, what I do currently. As Osajifo mentioned, right, I'm an investment and associate of Sentinel Asset Management. Um, I got into finance in 2013 when my cousin introduced me into Forex trading. The way he actually narrated Forex trading to me, it felt like if I come into Forex trading, I'll be the next billionaire. Or I'll be like Auntie Quill and all those Instagram flashy guys we see. That was the whole notion that when I start Forex trading, I'm just going to blow up and buy a Corvette and start driving. Little did I know of what I was actually getting myself into. But I actually love the fact that I got to know the dynamics of what happened in another country can have an effect of the currency of another country, like the whole relation and how the economies of other countries really, really do relate. It actually made me see that, look, the world is a global place. Currently now, geopolitics is making feel like right now we don't have to be globalized, but when I started learning about Forex, I was so intrigued. And I was like, you know what? I'm in SHS, but I know what I want to do. I just wanted to manage people's money, right? So I decided to study um banking and finance in University of Ghana, just mainly for me to grab and just have a certificate that would actually say that, hey, this is more my intention and how I intend to get into the industry. I started my official or formally in an investment industry with as an intern and in a brokerage firm, which is the Bullion Investment Group, is there with their subsidiaries, which was Intrepid. Also, it was an asset management firm, not very known. It was located in Octagon, right, in Accra. I also did when during my internship, I had opportunity to become a compliance officer where I was I was given the monthly and quarterly reports to the regulator. So I was having a snippet of what was happening in the industry, visiting the Ghana Stock Exchange and also the SEC on a quarterly and monthly basis. Back then, we had to submit everything physically. So I was doing those rounds. And then I moved into investment analysis a bit with the investment arm of Intrepid, where I was doing research of companies I wanted to invest in. And I had opportunity to draft the first fixed income fund that the firm was actually trying to bring onto market by then. Intrepid then got acquired by Sentinel Asset Management, and that's how come I got into the role of where I am right now when Intrepid got acquired. Currently, I'm a CFA level 1 candidate. I'm a licensed fund management representative. And also, one of the biggest transactions I worked on was in 2022 to 2023, where I worked in the acquisition of One Airport Square, which Osajifo mentioned, and then where we were able to bring into the first commercial real estate into Ghana, right? So you asked like this is what actually how I started into the fund management industry. And I already mentioned what excited me, and it still excites me though about how the decisions you sit down to make affect the lives of people. If you make a wrong decision, yes, obviously you rush into your capital allocation, you see how your investment will go and how bad it goes may affect the lives of people, mainly because you are managing pensions money. So the decision you are making today will affect what someone's father would earn in the next 10 years. So you have to really put things into perspective. You don't just come to work and just assume, okay, put money here, put money here, put money here. No, you have to think about it in the long term because every single outcome you do, right? It's double checked by a lot of people. That's how come it's formalized. It's different from when you come in the retail industry where I would like to put things into the Forex perspective just because since that's the audience here, right? So you've seen a currency pair that you are so interested into. You're looking about the maybe the USD and the Japanese yen, right? You just come up with an idea. I think with the rising rates in Japan, the Japanese yen will actually be stronger than the USD. So hence, I'm just buying. No, you don't do that in the formal industry. When you are a fund manager, your your execution, before you even execute, right, it goes through a whole process. There is an investment committee that would give you a whole strategy of what we intend to do. You are just an executioner, and what you just have to do is allocation of capital. And even before you do so, there's a board of trustee. You recommend your investment, you give them the rationale of what you intend to do, and they deliberate before they give you the go ahead. Because whatever you do would affect a lot of people, and you do. And how you actually do so, I would actually tell you the whole day-to-day process when we get to, I think, slide 10 or so of what we do, right? And how we actually allocate capital to different um, productive investments, right? So I would want to break things down to the layman view of what fund managers do and how we help shape the financial markets in Ghana. You remember I mentioned a big figure of 168 million Ghana cedis just lying in the bank and also outside the bank, right? So these are people who have money, savers, which are more of institutions and then individuals. Now they have this money. They want to earn some return of this money because it's just lying down. The banks are just paying a meager of almost 2% annually to you. That's nothing compared to the fact that you're just giving them free money to just allocate to give it out for loans or other things. You're just giving them the discretion on what they should use your money for. So these savers who have money, right, would say, hey, I want to generate money. I want to generate income off my money. So what they do is they would allocate this money to fund managers. Fund managers will do investment analysis. They look at the risk appetite of people that have given them the money and then allocate capital to people that need the money, right? So the people that need the money could be companies, they could be governments, it could be individuals or that have investment opportunities, right? There are many asset classes. We could talk about the fixed income, we could talk about equities, we could talk about other collective investment schemes. There are a lot of asset classes that you can invest in. But a fund manager will look at the risk appetite of the people that have given them the money. They're also what their objectives are, whether they are going to be long-term holders of capital or they are just going to be short-term before they allocate this money to the investment opportunities that they have. Now, these investment opportunities are supposed to generate some returns, and these returns will go to the fund managers. It could be losses as well because you don't assume that anytime you put money into something, it will surely generate a positive return. It could also go bad too as well. There's no guarantee in investment. So always have that in mind when someone decides to say that, hey, put money here and then you are going to get 10% every year. That's a red flag that you need to actually notice, right? So their fund managers are not doing it for free. Obviously, they will take a fee. So they actually generate these returns and take their fee, and the net of the returns is actually being repatriated or being distributed back to the savers. And that's how we do. And that's what I just explained what the graph here for you to understand the whole process, right? So how do they actually shape financial markets? Look, they come up with these products, right, that's able to push money into innovative and productive sectors. The real estate sector is booming, but not everybody has money to invest into real estate. So they come up with products, take money from these savers together, bring it together, and now they are able to invest into developmental projects. And that's how come they do what we call the capital allocation, where they allocate money that has been received to to sectors that would at least generate some value to investors. They also enhance market liquidity in the sense that people just, let me give you a clear example. You buy fixed income securities, you buy a treasury bill, and you're holding it for 91 days. What if after investing on the 10th day, you need an emergency, you need your money? How do you get it? So for the fund managers can buy off that treasury bill that you are holding on your behalf. So they provide liquidity, which will allow you to enter and exit whenever whenever you need it. And also, yes, they will provide valuation because look, what's the value of the security you hold? You don't know. It is the fund managers that are going to say, hey, as of today, this is the value of your money. And this is the value of the security you hold, and hence we'll buy it off you and we'll give you a clear indication of what you want to do with that security that you want to hold. I told you they come out with innovative products. I can give you a clear example of an innovative product that's onto the market, right? Um, think about it this way. You know, if you want to buy an Eurobond, let's say, look, Nigeria is doing well, and I want to buy a security in Nigeria, right? I want to buy a Nigerian Eurobond. An Eurobond is generally a bond issued by a country in a different currency. So Ghana and cedi. So if you are issuing a bond, our bond should be denominated in cedi. However, Ghana can issue a bond that is dollar denominated, and this would be open to international investors who want to earn some dollar return. So Nigeria is doing well. Nigeria has a whole lot of dollars in their reserves. So I've done analysis and I'm like, look, I want to have a snippet of the Nigeria's economy. So how then do I do it? Okay, now this is the Eurobond that's been issued. These are the number of Eurobonds issued by Nigeria. Now I want to buy it. Do you know how much I need to get that? I need to buy one lot, and one lot is $200,000. That is a lot of money. How many Ghanaians have $200,000 to buy just one lot? So hence, fund managers come up with a product where they will take money from all individuals and institutions, and they will allow them to get exposure to this Nigerian growth economy by bringing the money together, and now they will buy these Eurobond for you, and then the money is being distributed to everybody. Everyone gets to benefit in terms of exposure or into that country. Sorry. So fund managers, I can go on and on and on about what they do, but I'm sure the slide will be shared with you afterwards to go through again. Then we'll come to my next slide, which is how do I approach risk assessment and managing in terms of managing a diverse investment portfolio. So managing a whole diverse portfolio is very important for you to know, look, what is the risk level I'm okay with, and how do I manage my risk? Managing risk is not, you can't, look, the word here is managing, because you can't do away with risk in investment. All you can do is manage risk. And the best way you can manage risk is by diversifying. I repeat, the best way to manage investments is the diversification. But I wanted to give you a day-to-day on what I do to assess the risk of a particular investment before I then allocate money to it, right? So it depends on the asset class, right? So we can, if you look at a fixed income asset class, you look at equities, we normally do what we call the fundamental analysis, which I'm sure your boot camp, I had a snippet of it. I'm sure you've been taught fundamental analysis and you've been taught technical analysis, where they open the trading view for you to have a clear indication of some of the indicators, right? So let me start with fundamental analysis. Fundamental analysis just basically talks about the macros. What are the things that you are very much aware of? So in fundamental analysis, you're looking at the GDP, other indicators. I think in my other slide, I would really go deep down into fundamental analysis. But just fundamental analysis just tell you about, look, think about it in the layman's view. I'm going to put money into this company. How is this company performing? How is the industry? How is the whole economy doing? Is the economy going down? If the economy is going down, is this the right time for me to invest? if I want to invest, which of the companies or industry are going to do well in a downturn in economy? That's where the fundamental analysis come in. Technical analysis, I'm sure they've given you some sort of indicators of what it is, right? Where you're looking, if it's for an equity or even Forex analysis, in terms of you are looking at, okay, are we on support or we on a resistance? You're looking at patterns recognition. You're looking at using indicators like the RSI. You're looking at the moving average, convergence, divergence, all those technical indicators, which I'm sure Osajifo and his team has been talking to you about. These are some of the things that we do on a formal basis. Yes, you do it for equity analysis. Sometimes you do it because you want to look at the relative strength indicators of a stock, just for you to gauge some sort of how liquid that particular stock is. Those things are, but they are rarely used in Ghana. However, if you're looking at Wall Street and other developed markets, it's something that people do as their indication before they invest into it. So let me break it down once again. Look, if I've done my analysis and I know, like, I have noticed that this particular stock is not liquid, that because of the illiquidity of that particular stock or that particular investment, I need to put a risk premium to it. So I can give you a clear example. I mentioned about the treasury bill. I bought a 91-day treasury bill. If the 91-day treasury bill, I'm not getting people to buy it, and I have to hold it for 91 days. That investment is illiquid. And since it's illiquid, I will need a premium or a much more a return to justify that particular risk I'm taking, because it means I have to hold this particular investment till maturity, which is when it ends. So I would actually struggle. So I would want that particular security or investment that I hold to give me some premium. Now, let me break it down back again to the slide, right? When we talk about idiosyncratic, sorry again. When you talk about idiosyncratic risk, right, or systematic risk, right? These are the two types of risks that we see in the investment industry. Systematic risk is something that has to do with the whole industry. It has nothing to do with the company or the investment that you're investing in specifically. So systematic risk is an example of systematic risk is what happened in 2020, 2019 when COVID came. It had nothing to do with a particular company, but rather it affected everybody. So it's a systematic risk in which you can't do anything about it. All you can just do is to diversify in order to reduce your systematic risk, right? Unsystematic risk is generally what has to do with the company. So hence, you need to find mitigants for those particular risks, right? So in doing that, you would write down what you think will be your possible risk and what your mitigants for those risks will be. If you're looking for returns, what will be the catalyst for these returns? What is going to push this particular stock or this particular currency to go up? I would like to bring everything down to FX to make it so easy for you guys to understand. Look, I'm looking at maybe back again to using the USD and the Japanese yen, right? Where I mentioned that because, look, Japanese yen has always been lower, which has been always facilitating the carry trade for these US investors, right? Because with a low interest rate, I can just borrow from in Japan and then invest in high security or high yielding securities in the US. So based on that notion, and right now everything has reversed. The central bank of Japan is actually hiking the interest rates in Japan. So hence, look, I'm like, hey, since that's happening, hence the Japanese yen is going to gain some strength. So since the Japanese yen is going to gain some strength, what are some of the indicators that I'll be looking out for? That will be the catalyst for returns. So the indicators I'll be looking out for is when they decide to hike rates. So I have those days in my calendar. I'll be looking out for some events when they're having their meetings, what's happening in their stock market, and all those are catalysts for returns. And then what are some of the things I can use to mitigate my risk? I'm sure when I get to the other slides, you would hear about the stop loss and other ways to mitigate your risk. So now I have identified this security, I've identified the risk, I've identified my catalyst for returns or growth. I'll assess it and look at which of my clients would this fit. I'm managing pension funds. Pension funds are meant for people who are going to benefit in the next 10 years. Since I am going to do that, I'm going to look at the profile of the scheme members. So if I notice that the scheme members are people who are almost nearing their retirement, I do not take huge risk. I repeat. So I'm looking at people, if I look at the age distribution of the scheme members, they are around 50 to 60 years. That's not the time for me to be investing in stocks or FX because those are high volatile in asset classes. So hence, I actually allocate majority of my funds into less volatile securities, which is bonds, treasury bills, and money market securities. So I put my money into fixed income securities as compared to more into stocks. That's how I'll actually allocate my funds or ensure that my investment portfolio is not that exposed to high risk, right? So if I'm looking at pension funds, this is how I'll do it. But if I'm looking at maybe on my proprietary funds and I'm looking at an age distribution where these people are relatively younger, I can be able to take in some risk. Maybe allocate 40 to 50% of my portfolio into uh, high risk asset classes like stocks, right? That's a way that I can do that. But remember, I do not make those decisions myself. I have to go through the investment committee. And this investment committee is a group of people who are experienced from diverse investment background. Some of them have had experience in fixed income. Some of them have had experience um, in maybe let's just say real estate. Some of them have had experience. Some of them are even accountants and things, and they all have different diverse views in terms of investment. So I make my proposal to these investments to the investment committee. They then look at what I have proposed and then can then judge whether I should go ahead or not. When they give me the go ahead, then I now look into my portfolio and say, okay, if I look at my schemes, I would want to allocate this for this particular scheme. I'll allocate 5% of the portfolio to this investment, 10% to this, 10% to that, or whatever. That's the job of a PM. After the investment committee has looked at your proposal, then you decide on what to do. But I told you the much more important thing you have to do is diversify. You don't put everything into one particular investment or asset class. Of course, it can hurt you. That is what happened in 2022, 2023, where we saw the majority of our fund managers had their money in government of Ghana securities. They were not diversified. And because of that, when mark to market came in and the DDP came in, you notice that the mark to market affected the investment of people. And we even had some people going for demonstrations, people trying to get their money and they were not able to get their money, mainly because of mainly because the fund managers had not diversified. And this is when it actually affects that I'm saying that the decisions you make can affect the lives of people. And we heard sad stories where people lost their lives, people fell sick and things. We couldn't pay their rent and other things, mainly because they had their money locked up in these investments and they were not getting their money on time. So in terms of what hedging is, I decided to give a narration or something easy on what hedging is. And I said, look, imagine you're going to work and the weather looks nice. We saw what happened last week Sunday, where the weather looked fine in the morning, and all of a sudden we just rain started dropping, right? So imagine you're going to church even, and you just said, you know what, let me pick an umbrella just in case rain falls. We are in a dry season. You don't expect rain, but you're just saying just in case. And it's now 11 o'clock, church has closed, and now it's raining. The umbrella you took has saved you. Actually, because of the umbrella you took, you were dry and you were not wet. That's what hedging is all about. Hedging is you actually taking some initiatives to protect yourself in case the downside happens. right? You can't prevent it at all, but however, you can reduce the damages that it causes. And for individual traders like yourself, right, in Forex trading, um, look, you have your $1,000 invested in your brokerage account. You've seen this pair that you like so much, and you say, okay, you know what, let me trade gold. You've done your whole analysis and you decided to trade gold. Since you're trading gold, or you open like 5 or 6 positions in gold, which makes you've actually exposed like 40% or 50% of your entire portfolio into one particular trade where you've bought gold, thinking that yeah, gold would actually rise and you are going to get some decent return, or you're going to be in the blue very soon. But have you noticed something? You've exposed 40% of your whole portfolio into just one trade idea. Doing this would affect or blow your account, especially if you've had some leverage, or you're trading in high you had some leverage, obviously, because when most of individual traders invest into these brokerage accounts, they're taking leverage of almost 400%. And that's what the brokers would actually offer you, because they want to magnify your return. And you blow your account, and immediately you see them smiling, because they'll smile to the bank with your money, right? So in order not to expose yourself into these kind of issues, what is always advisable is you always diversify across uncorrelated assets or even currency pairs. So look, you're okay with your good idea, right? You can have another trade which has to do with oil play, where you believe that oil is going to gain some strength. Since oil is going to gain some strength, there'll be some currencies that you're not going to be stronger. Where when oil is rising, we normally see what happens to the Canadian dollar. The Canadian dollar gains some strength. So you have some positions in some positions that is uncorrelated to your gold trade, right? And it is always advisable to have at least a stop loss for all your trades. Don't assume of the high side. Always, it's always advisable to have some stop loss. We always do that even in our equity investment here formally, right? When we do our analysis and we have a trade idea, we don't assume that stock is going to go up forever. No, when you buy it, you want to have a take profit um position, and also you want to have a stop loss too. Your stop loss can be it depends on you, right? Some of you have your stop loss and you look at if it is a buy trade, you look at where the lower support is, and that's when you put your stop loss. That's when you're doing technical analysis. However, when you're doing that in equities, it's not done. So you could say that, look, if your investment or your position draws down by 20%, you would want to take out your position. So it's always advisable to have these things. This is a way of you to protect your downside, else you end up blowing your account, which most retail traders do in less than a month or two of when they invest their money, because they do not have this risk management mentality when they are investing. They assume everything will go up, right? And also investing in safe having assets, right? As an individual, this is on your own personal level, where you're saying, okay, no, I think let me just go back and just give you a scenario of what happened. You remember in 2020, 2023, we saw wide swings of our currency where CD started losing ground because in 2022, the government was unable to access the international market. Since they were not able to access the international market, we couldn't bring in or issue a Eurobond, which would have plugged in some of the repatriations of money that is leaving US dollars that is leaving the country. So hence there was a free fall of the Ghana cedi. We saw the law panicking. What were people doing? We saw that people were trading their Ghana cedi to buy dollars. Forex bureaus had queues and they were buying dollars because dollars was seen as a safe haven asset at that point. So you as an individual, on your individual, you may have money everywhere. You may have investments and things. I said invest in uncorrelated assets because when this one is going up, you would want to have an asset that would also be able to hold it when it's things turn around, right? So with your Ghana CD, you decided to hold dollars because dollar was having some strength and will be able to hold you down or so that you don't lose much value of your Ghana CD. So that's what people were doing. They were buying dollars. Some were buying euros, some were buying pounds, just to make sure that the CD that they have will not lose value all the way. At least they will have some value retention, some value retention. That's what we call by hedging. You are just taking some initiatives to ensure that should anything happen on the market, you would be able to reduce the damages or the losses that you're going to incur. And the most effective way to balance your high risk and low risk assets in your portfolio. High risk assets are generally those are very volatile. So, stocks are very volatile, even FX are very volatile. So, even if you look at even in FX, some currencies, they have some currencies that are very volatile. You could see example, right? Like these cross currencies, right? So look at Ghana CD and US dollar. In a day, you can move by 2%. It's not normal. Those wild swings are not normal at all. If the US dollar and the pounds move by even a percent, it's a headline. If it moves by a percent or 2% in a particular month or even a day, it is a headline. But in Ghana, we are seeing 20%, 30%, and it sounds very normal. It's not at all. So these currency pairs are very high risk. So you notice that even the spread of these spreads are of these currency pairs are very high. If you're trading, you even see it. The only currency that even at least very catches up a little closer is the South African rand when you're trading that against the US dollar, right? But that's not what we are here to do. I'm just trying to just give into perspective of what high risk, what high risk pairs are and even low risk pairs in terms of the Forex perspective. But in terms of the portfolio management perspective, high risk assets are stocks, stocks, derivatives, options, forwards, futures. These are high risk assets, right? And the low risk assets are the ones that you can at least manage. You know what your downside is and what your upside is even capped. So if I invest my 10,000 Ghana cedis into a treasury bill, a 91-day treasury bill, I know it's 28%. That's what I'm going to get. So I know what my return is. What my loss is generally is I may lose my principal. So I may go to zero and my highest I can get is 28%. If you compare that to stocks, it's different. Your upside is not capped, but your lower side is capped at what you invested, which is your principal. Unless you took some leverage, which is a different all together, right? So now you know what the high risk are, what the low risk are. What we do, or what I do, or my job is, look, I'm supposed to assess my client's risk appetite. And as I mentioned that I know what my clients are, what their risk tolerance are. So for pension clients, they have low risk tolerance. So I don't invest majority of my funds into high risk assets since I know their risk appetite is low and their investment horizon is very long because they are investing now for their pensions, which will be 15, 20 years from now. Since they have a very long investment horizon, I would want to invest into funds or assets that have long uh, investment horizon, but low risk. Well, I pick it up again. Pensions assets or pension funds are for clients who have low risk tolerance and yet a longer investment horizon. So hence, I'll look for assets that have longer investment horizon, right, and have low risk. Such assets are the fixed income assets, which is bonds. So I'm investing in a 10-year, 20-year bond, even as high as 60-year bond, right? I invest these funds into these bonds, which are long-term. Long-term, I know what they are supposed to get. They'll end their coupons or they'll end their coupons before they'll end their principal upon maturity. So majority of Ghana asset allocation is more geared towards fixed income securities. And that's what most people know, and that's what they are very comfortable with. So now I profile my clients. I know what will work for them. Now I know their objective. Their objective is for capital preservation. They want the value of the money, the 300 CDs, 400 CDs, or 500 CDs they are investing today. They want it to have that same value when they retire. So for me to make sure they get that, means I have to get something that beats inflation. So I have that in mind. I have that in mind before I actually allocate their money. So I have that, I know I profile my clients. I know what their investment objectives are before I then do my portfolio construction, where I then say, knowing my clients, this is where I'm going to put their money in. I'm going to put my money into fixed income securities. I'm going to put my money into long term. I'm going to allocate maybe 40% here, 30% here, 10% here. And I'm always going to diversify. I'm not going to put all my money into one particular place. The clients have given me 1 million and I'm putting all the 1 million into a government of Ghana bond. Don't. I have to diversify because clients may have liquidity issues, may want their money sooner. We saw what happened. We've always been taught in economics that the government doesn't default, but of course, that's what it is in theory. But in practical, the government of Ghana has defaulted before. So these are things that you have to have in mind before you allocate funds into a particular portfolio. And I always say, look, you always have to rebalance to ensure that the risk level does not go above what you've been looking out for, or what you actually had in mind when you started the investment. So, for instance, when the government of Ghana defaulted, what that means is the government's risk level has gone high. There's a high possibility the government can default again. So hence, what do I have to do? I have to start reallocating or rebalancing my portfolio and not putting everything back again to government of Ghana by buying treasury bills, because it's the same issuer. So hence, I'll be exposing my client to high risk. And if I'm exposing my client to high risk, then it means I'm moving from a low risk asset to a high risk asset. And then I have to rebalance my portfolio. So it's very important that when you're doing your portfolio construction, you always periodically, you have to be monitoring your investment and be rebalancing your portfolio you are you are still investing, or you're in the investment life cycle, right? Now, I mentioned I'll come back to um, the fundamental analysis, right? So when you're doing fundamental analysis, it's just the same way what you do. What I do is the top-bottom approach. So we have, sorry, is supposed to be top-down approach. My apologies. There is a top-down approach and there is the bottom-up approach, right, in investment. So with the top-down approach, what I start to do is I look at the macro. I start with the macro. So I do a macro analysis and say, look, I want to invest in Ghana. Is the economy growing or it is shrinking? That's my first stance. Now, okay, the economy is growing. What are the drivers of the growth? If it is industry, it is service, it's agriculture, I have those in mind. Those are indicators that I have in mind. Then I look at inflation. Is inflation increasing or there's disinflation? If inflation is rising, then I have that in mind that whatever it is I'm going to invest in, I would want it to have at least beat my inflation or be at par to inflation. Now, what's the interest rate regime? Are interest rates high or low? If interest rates are high, whatever I'm investing in should also give me a higher, should give me something higher than the general interest rate environment, or should be at par. Now, what's happening to the currency? Is the currency strengthening or the currency is depreciating? I need to have that in mind, that whatever I'm investing in, should the currency depreciate by 10%, would it be able to give me much more return that would make me still maintain or give me value for my investors? Those are the indicators I look out for. That's on the macro level. Then I look at the sector. So if it's a now let me put it into perspective. Let's just say I'm trying to invest in a company. I have a company in Ghana, right? Or let's say a company that's listed on the stock exchange. So first, I have started with the macros, so I know what is happening. Now I look at the industry, right? Let's just say if I'm trying to invest in which of the industry is actually booming. It's a service sector. For the service sector, ICT is booming. So if ICT is booming, what's even causing ICT to boom? Mainly because there's much more fintech coming up. People are becoming more financially literate. People are getting to get exposed now. People can't do away with mobile money, interoperability. There's much more communication, AI and data driven and everything. So now I noticed that ICT is booming. Now, if I look at ICT is booming, which companies can I invest in? Unfortunately, we have only one company that's listed on the stock exchange that's relating to ICT, which is MTN. So now, if it is MTN, then I have to now do some quantitative analysis of MTN. What is their return on investment? How have they been performing? How has their revenue been growing? If their revenue growing, what are the drivers of the growth? Is it voice? Is it data? Is it mobile money? What are the drivers of growth? That's when you're looking at company or you're doing company analysis. So now you're looking at MTN specifically. So I first started with the macros, then moved to the sector, then now I've come to the company. Based on this analysis, then I now decide, okay, what is my whole purpose? Am I investing because I want capital appreciation or I want dividends? These are the things I would look out for before I now invest or I make an informed investment decision.